What's up, audit fans? Dr. Amanda White here with our Standards Explained video on ASA ISA710, which is about comparative information and corresponding figures. Now, you might be wondering what that actually refers to. Typically, in our financial statements, we will have our current year, and then we will also have the prior year figures so that people can make a comparison between the two. That allows people to do things like some sort of percentage change analysis. They might look at ratios, because quite often examining trends in figures can be quite important for evaluating that information for decision making. If we look at our table of contents here, it's pretty standard. We're going to look at the scope of the standard. What is comparative information? We'll actually go through some basic definitions, the requirements, which is the legally enforceable component, and the explanatory and other material, which I'll leave for you to read yourself. But I do recommend having a look at things like the appendices of what we do in terms of audit reporting when perhaps there are not comparatives or the comparatives are not appropriate. As always, this standard conforms with International Standard 710 about comparative information. So if you're an international student, you're studying the ISAs, then this video is just as appropriate for you. Let's dig into the actual standard here. And if we zoom in and we look at the scope, it's pretty straightforward. It's our responsibilities relating to comparative information when we do our audit. Do we have to think about prior periods and their comparative information, or what might we need to do? If it's the first ever audit, then it's not going to be us, and we need to consider ASA710, which is the standard about opening balances. Because a lot of firms will have their very first audit, and we do need to be careful there. So go back and have a look at ASA710. Sometimes our audit is done by a different audit firm. Remember that firms do change. So there is the possibility of a change in the auditor, and that change can be for a number of different reasons. It could be that they have want consulting services from that auditor, and so they're considering breaking ties and giving the audit to someone else. They may decide that that audit firm no longer suits their needs. So remember that in some jurisdictions we do have rotation of auditors or audit partners, so we do need to consider that. So what exactly is comparative information? Well, if we look here in paragraph 2, it's information that's presented in the financial report, and it depends on the requirements of the applicable reporting framework. So here in Australia we have our AASBs, and the situation or the standard that applies in this situation is going to be AASB 101. Now, there are two options for comparative information: corresponding figures and comparative financial reports. So I'm going to jump out of ASA710 and I'm going to go into the AASB. Here I am inside AASB 101, which, if you're looking at IFRS, that's going to be IFRS 1. Or International Accounting Standard 1. So let's look at what is required here in Australia. So except when accounting standards permit or require otherwise, an entity shall present comparative information in respect to the preceding period for all amounts. We have to provide comparative information for everything within the financial statements. Now, in terms of the requirements, we have to have a minimum of 2 statements of financial position, profit and loss, income, separate statements, cash flows, etc. So you don't have to have 2 sets of the notes, but 2 years at a minimum. So therefore it is possible that a company might have 3 years of comparatives, but that's not common. Typically we see the 2. Now, what happens if there's been a change? Because it is possible, and when I was talking to Dr. Nelson Marr in one of our Count Me In podcasts, he says it's actually possible that the closing balance from one year doesn't equal the opening balance in another because the company's gone through some form of restatement. If there is some sort of restatement, they have a 3rd statement of financial position so that they can have the comparative. So what that actually looks like is that they'll have, let me get my pen up, closing from year 1, then what they'll have is the opening from year 2 and the closing from year 2 for a balance. Now theoretically, this one and this one should be the same. All right, so if there have been no restatements, this number will be the same. However, if this number is different, then we need to make sure that we've clearly stated that. And that could be different for a number of different reasons. They might actually find some sort of error. Oops, we found a mistake, we're going back to fix it. There might be some sort of change in policy that needs to have a reclassification, but quite often firms may not disclose that there is this difference in them. So there is actually a whole lot of research looking at what we call restatements. And if you're interested in that, let me know and I can put you in touch with someone who's a bit more of an expert. We understand now that our accounting standard says we have to have comparative information for everything on the financial statements. Can't just do some or none, you have to have both. So we have different approaches when it comes to how we audit these. So for corresponding figures, then my opinion refers to the current period only, and for comparative financial reports, it applies to both periods. Now you might think which one will we be using here in Australia, because you see the information or the terminology within AASB 101 of comparative information, and it does say 2 sets of everything. However, if we scroll down here, we have a very specific paragraph for Australian users, which says our applicable financial reporting framework, which is AASB 101, and here's the important bit, comparative information refers to corresponding figures. So for us, we are going to be following here in Australia this option. The opinion refers to the current period only. Now, if we scroll down and we look at the definitions, our definition is that corresponding figures mean comparative information where amounts are included as an integral part of the current financial report. And when we say integral, you know, they're right next to each other. So typically, we have all of our different line items, and you have year 1 here, and you have year 2 here, and the items are right next to each other. So integral means that they're quite close together and to be compared together. So what we're doing is we are actually only auditing that period. Year 2, we're not also auditing year 1. We'll think about year 1 in relation to the ASA regarding opening balances, which from memory is ASA710. So what are my requirements? Remember, my requirements are the things that I must do by law. So I have to decide whether the comparative information is appropriately classified. So I have to figure out, well, does it agree with amounts and other disclosures from the prior period? So in year 2, I have to actually go back and decide, well, okay, does this match what we saw at the end of year 1? And if it hasn't been, I have to go back and say, well, why were they changed? What was their restatement? I also have a responsibility to look at accounting policies and say, well, are we using the same accounting policy so that I can compare information? Because if I'm using, for example, straight line depreciation in 1 year, in year 1, and then in year 2 I go to reducing balance, then it's really difficult to compare this with this because we don't have apples and apples or comparing like with like. So if we've got accounting policies, I need to make sure that those accounting policies are consistent with what we did this year and last year, or if there are changes, whether they've been properly accounted for, presented and disclosed. And quite often if you do have a change in an accounting policy, you need to provide, well, not necessarily a restatement, recalculate the comparative to show the difference and say, well, we've changed accounting policies, here is what a like versus like comparison is going to be. Now what happens if I become aware of an issue? I think, oh, maybe potentially there's been a restatement and something hasn't been appropriately disclosed, or they've had an inappropriate change in an accounting policy. Well, like anything relating to gathering evidence, I have to collect sufficient appropriate evidence to say, is there a misstatement caused by the comparative information? There are different situations to handle here. What if I did the audit last year? If I did the prior period, then I go to ASA 560. All right, and I have to go back and think about, did I need to change the prior period financial report? If I didn't audit the prior period, then I have to go back and I have to consider, could there be an unintended or an undisclosed error? Do I need to think about opening balances? Now, under 580, which is management representations, I should also get a written representation request saying that they've given us any information on misstatements or things that might mean that the prior period is different that could affect the financial information and the comparative. So we're saying, management, please tell us about all of the things that could be different from our prior period, things that might have changed, and then write those down. So how do I go about actually reporting this? Because this can be a little bit difficult. When it comes to my reporting, I do not refer to corresponding figures except where I think might be something might be different. So in Australia, corresponding figures is what we're actually required to follow. We're not looking at the full comparative information where I would audit both sets of financial information. Back in our series on audit reporting, if I'd previously issued a qualified disclaimer or an adverse opinion and the modification is unresolved, so I proposed some sort of adjustment, and if it's unresolved, we're really saying management still refuses to make a change to the accounts, then I have to be really careful. I have to make sure that I modify the opinion in this period. All right. If last period was modified because they overstated sales and they still refuse to change, then I automatically have to modify this period because last year's figures and therefore the flow-on effect, because this is really driven by a flow-on effect, is going to result in a material misstatement in this period. We need to make sure that we also consider whether the effects are actually material. Right? If they're not material, then we probably wouldn't have given one of these opinions. If I'd given one of these opinions in the prior period, you got a pretty good chance that that was actually material. Now, what happens if last year I gave an unmodified opinion? If last period I did the audit, I gave an unmodified opinion, but then I get evidence that we had a misstatement, that what I did was that the auditor missed something, then I have to consider a totally different tack. Now, if the corresponding figures were not restated or they haven't made any disclosures, I have to think about a qualified or adverse opinion. So if I missed a misstatement last year, I'm going to need to go back, recall the potentially recall the opinion, ask management to restate. If that hasn't been done, management haven't recalled the financials, we haven't restated it, there's been no disclosures, then I have to go with a qualified opinion there. And I have to have lots of discussion that there is that issue. Now, sometimes I don't always do the audit of the prior year. So what if somebody else does the prior period audit? Then I have to refer to the predecessor's audit report. And I say, well, last year, somebody else did the audit, and I give an other matter paragraph. Somebody else did the other period, and here was the opinion from the previous auditor. So that's quite straightforward. If we didn't do it, we'll probably see lots of those within the financial statements because a lot of companies change auditors. But what happens if it wasn't audited? Well, then we state that in an other matter paragraph, and we make sure that we apply ASA 510, we have to consider opening balances. Now down here we have comparative financial reports, and remember this is not the Australian situation. Okay, so that's not something that we're going to apply here in Australia, but when you do the audit of the comparative financial report, you're auditing this year and last year. Okay, so you can read through, if you're auditing comparatives, again, the rules and regulations are pretty straightforward about what to do. That's it for our video on ASA710. If you have any questions, please always pop them in the comments. Otherwise, I will catch you in the next video. Thanks, and I'll see you next time.